Hello, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. This is the week of August the 19th, 2019. And so if we're looking at the current market state, the market's still kind of in a transitional state. This was caused by a spike in volatility that happened on August the 5th. And so if we look at all the individual U.S. indexes, the S&P, the Dow, and the NASDAQ are all transitional. The Russell, which measures small cap, is actually a little bit more bearish. The EFA is kind of a transitional bearish, and emerging markets is also bearish. 20-year treasuries are bullish, along with gold and the dollar. And transitional markets are like a box of chocolates. You really never know what you're going to get. So we've actually seen 6 days out of 9 be plus or minus 1% or beyond. As opposed to the previous 33 trading days in a bull market, we actually only saw 1 day beyond plus or minus 1%. Canterbury Volatility Index measures CVI 83, and for most equity indexes that it has been increasing because of the recent spikes in volatility and those kind of days beyond plus or minus 1%. So volatility is rising on most equity indexes. And even treasury bonds, which had kind of gotten parabolic as we mentioned in the past, have seen some rising volatility. And so for the market comment, the S&P 500 has kind of found some short-term support. If you go back to October, November of 2018, it had overhead resistance at 2820, but then following the trading anomaly, it broke above that, and that 2820 level has kind of become our current support. So we've seen in this transitional market, the S&P drop to that level and bounce off of that twice now. So we're kind of looking at the 2820 as key support there. As opposed to the Russell, which is, as we mentioned earlier, a little bit more bearish. The Russell has overhead resistance at 1600, and that's the same overhead resistance that it was back in October and November. So it's really failed multiple times to break above that 1600 line. So that is a little bit more bearish. But we really don't want to compete against any individual index or benchmark because investing is a lifetime endeavor, and you're going to go through both bull and bear markets on equity indexes, bond indexes, gold or the dollar, any liquid traded security will have both a bull and a bear market. And so investment success is about adapting to those environments and using adaptive portfolio strategy like the Canterbury portfolio thermostat. And to help measure whether or not our portfolio is efficient for the current market environment, we've developed a portfolio efficiency score, which takes into account portfolio state, volatility, and benefit of diversification. And so if we're looking at that efficiency score, which is currently 95, that is efficient. That means the portfolio is efficient. Anything between 70 and 100 is deemed to be efficient. And so our portfolio state is bullish. We're holding a combination of securities that can benefit from the current environment. Our volatility is CVI 57. That has been increasing, but that's still a pretty low and stable number. And our benefit of diversification, or how well our portfolio is diversified, is 30%. And so in a bull market, we want to see that number be between about 25 and 35. And that's kind of the same case for just sort of a transitional market starting out. We want to see that number in between there, which it is. It's at 30%. So in other words, all the securities in our portfolio are moving differently from one another. They're not all highly correlated, which is good. Moving on to some Canterbury research, using our volatility weighted relative strength, which is kind of a risk-adjusted ranking system. If we're looking at S&P 500 sectors, real estate, staples, and utilities are the top 3. And if we're looking at style indexes, large cap growth, mid cap growth, and large cap value are the top 3 for those. Whereas, small cap value, the EFA, and emerging markets are right near the bottom. So again, all assets are going to go through both bull and bear markets. We've seen the S&P 500 identify some short-term support, whereas the Russells, failed to break above resistance. The Russell 2000 is going to have times where it outperforms the S&P 500 and vice versa. The market's still trying to find its footing, but we're going to navigate through that with, an adaptive portfolio strategy. Because if we want to focus on long-term investing, we have to keep in mind that we have to make really good short-term decisions, which includes tracking a portfolio's efficiency, tracking the securities within that portfolio's correlations, and maintaining low and efficient benefit of diversification. And if we can do that, then over the long term, the portfolio should have the ability to limit drawdowns and compound returns. Thank you, and I hope you have a really good week.